Hi everyone, hope you're doing well. Welcome into this video today where we're going to take a look at Card Factory and JD Sports and their trading updates that came out today. Both stocks I own, both making very different moves in the markets today. And apologies, there's no intro on the whiteboard. I'll be honest with you, I just couldn't be arsed doing it and setting up the tripod, so I thought let's get straight into today's video. Yeah, maybe bring that back on the next video. Just to let you know, the private stock market group on the Patreon, the prices have now updated, so you can see here it's now £6 a month to join. I have changed the annual though, so if you do click on the annual payment, you can save 15% if you do sign up annually, which works out as £5.10 a month if you do want to join that. Links in the description. Obviously you can see what I'm buying and selling in real time on there, and on the weekend we're going to take a look at some of the other trading updates that have come out because there's a lot coming out this week on the UK markets. But let's start with Card Factory. So Card Factory, pretty good day today, up 7% as you can see here. Not really recovered the drop since the 20th of September though, after the market was a bit spooked about a bit of an update. We'll get onto that in a second. But obviously a stock I own, a stock that's done quite well for me, and I have been aggressively buying into Card Factory over the last kind of couple of weeks on this dip at the moment. Now, the update finally came out with Card Factory about how it's been doing. So if we have a look here, robust revenue growth with expectations for full year adjusted profit before tax unchanged. That's the headline we were looking for. Are they still heading towards their full year guidance? Obviously, the market on the 24th of September got spooked because they came out with an update and they saw the numbers of the profit dropping rapidly. And the market went, no way are they hitting this target that they are expecting to do. They are so far off it already on the first half of the year. The market sold it off and it had a big dip. You know, look at that dip there. It was down nearly 40% on that dip. And there was so much fear out there. Nobody wanted to touch Card Factory. Everybody was negative on it. People were saying, oh, avoid Card Factory. And I was thinking, well, hold on. If you look at H1, they basically said this was going to happen. This has a very good management team of track record of delivering on it. And everyone kind of panicked and sold off, even though they said H1 is going to be pretty slow, but H2 we're going to recover and we're going to bounce back. And today we kind of got once more a confirmation that they are bouncing back. It was pretty obvious in my opinion. You know, we got a trading update a few weeks ago that said once again that they were in line. We saw big insider buying. If you ever wanted a clue that if they're going to hit the trading update, look at the insider buying. You know, when you have the likes of the CFO buying shares, nearly 126k worth of shares between the two buys, and even Darcy Wilson came in with two buys. It was just proof to me like the management team think they're going to hit these numbers, and what we had today is confirmation that they did hit the numbers. They were very good numbers. It's what we kind of wanted, what we kind of expected. If you look here, the total sales was up 6.2%. That's very good amounts of growth for a high street retailer. People that love the like-for-like numbers, that was up 3.9%, so no complaints for the people that stare at those like-for-like numbers. This is the big thing. Gifts and celebrations was up 6.1%. So this was one of the big key indicators, if you listen to what management team was saying, is they were going to focus on selling higher gifts that are higher money. I'm getting distracted by this advert on the left hand side here. What's going on here? Yeah, they said that gifts and celebration ranges were up 6.1%. And this is key because if you ever go into Card Factory, you'll see that when you go to the till now, they've increased the amount of gifts they sell. Now, if you're selling like big teddy bears or whatever, them teddy bears are, you know, £10-15. They're a lot more expensive than like the, you know, £1 gift card. So because the basket is increasing and these items that are bigger, higher seller price tags, they're making more profit on them. That was one way they're going to improve it. And we can see here that's key because that was up 6.1%, but also you got to remember they're making even more higher margin on this. Now, probably the weak part was the online like-for-like sales. That was down 10%. Probably do need to improve that. Even though the Card Factory website was flat, the big thing was getting personal. That was obviously probably the thing that was dragging it down, even though they don't state the numbers what it is. Don't know what they're going to do about this getting personal. I personally, if I were them, I would kind of sell it off, but it's their call. But obviously this doesn't make a big part of their revenue, so it's not that much of an issue. Partnerships. So this is the other thing that they kind of said, is that we've signed a load of partnerships, the likes of the Aldi partnership, for example. Revenue grew 23%. Obviously really good there, and obviously a few acquisitions in there that's worth pointing out. Once again, effective delivery of productivity and efficiency savings. So we saw that they mentioned about savings as well, which was good. And basically everything that I said when I did the YouTube video, which was here, saying how they're going to bridge this gap, it was basically on that video, and that's what Card Factory have gone to do, which is obviously great to see. There was a bit about the outlookers here. So the board expects to deliver financial year 25 adjusted profit before tax. So in line what they were saying. They talked about the big increases in the NI. They said that that is going to have a 14 million impact on them, which is pretty big when you look at the profit that they are currently doing at the moment. But they said they're going to do, once again, with developing the range of developments and pricing. So once again, probably higher margin products. And I don't know if you've seen it as well. I've noticed a little bit. They've been selling the signature cards a lot more. There's definitely a lot more exposure to them, which are a little bit more expensive cards. And pricing. So once again, another company that's saying we're going to put our prices up. We're not going to absorb it. Seems like everything is going to, pretty much every business is going to do that. I mean, what that's going to look like for inflation numbers in a few months' time, yeah. But obviously they're going to put prices up as well. So they currently expect to deliver mid to high single-digit percentage in increase in adjusted profit before tax in financial 26. Obviously, yeah, we will if they can do mid to high single-digit percentage growth every year going forward, that's very good. That's all I can ask for this business. And then you start looking at the numbers here, and obviously we're going to close around about 7 times earnings. Next year's numbers, obviously, we'll see how they do. We'll look at the numbers that are given today. Maybe a little bit higher than this, but you're going to be around about a low 7-6 times earnings on this business, which I think is not too bad value at all, especially when you look at what the company historically trades at. You know, the company has normally traded at, if we look at like 2017, 2018, traded about 11-12 times earnings, which I think is about fair for this business. And once again, this company is going to be around about 7-6 times earnings, which to me just looks incredibly low for where it is. Considering as well, there was a bit of an issue during that time frame around the balance sheet. The balance sheet was sitting about 164 million in debt. Right now it's around about 99 million debt, so it's nearly half the debt on the balance sheet, which is obviously great. And as well as that, you know, the cash pile was obviously running really thin during that period of time. You know, they were down to a couple of million in cash. You know, right now that cash balance has increased rapidly, and yeah, it's a lot healthier business than where it was previously. As well as that, you've got to consider the dividend, you know, nearly towards a 6% dividend yield. And when you look at it, you know, there's still a little bit of room to hike up that dividend a little bit more going forward as well. So yeah, certainly a stronger position than where it has been for many years. You've got Darcy Wilson, who's proven that he can hit the targets that he sets out. Balance sheet a lot better than where it was previously. And I look at the share price right now, when you look at that fall off since September time, and you're thinking, well, how long now until it gets back up to a £1.20 stock, in my opinion? You know, we were valuing the stock at £1.20 off the numbers that they were supposed to do, and now they've hit them again. So when are we going to go back up there, in my opinion? I think the days till we get back up to a £1 stock must be coming sometime soon. I did have a look at the report from Stockopedia. They stayed amber green on it, which I was really surprised by, because I thought, okay, surely a company that is attractive value, it's historically a lot lower than what it has been previously, and since that period of time, like we said, the balance sheet's a lot better, the debt's in a lot better position, the cash is higher, they're back to where they said they were going to do, they've proven they can hit the numbers, the guidance is still good. How can this not be green? You know, the valuation is cheap, the numbers are good, they're growing. I was quite surprised with Stockopedia on their report that it stayed amber and green. In my opinion, it should be green, but it is what it is. It gets worse for Stockopedia in this video, so stick around for JD Sports. Anyway, mention JD Sports, let's go across to it. So JD Sports opened up, had a bit of a drop on the morning actually. It was actually down around about 12%, I think, at the open. So yeah, it had a fair amount of drop. I added in this morning, I'm not going to lie, since then it has bounced up a little bit. I'm not surprised. I thought the stock reaction was incredibly stupid. So yeah, obviously the report wasn't amazing, but should we have been down 10%? No, in my opinion. So if we just have a scan at some of the highlights that I've got down for you guys here. So the Q3 trading update for these guys, 14th of January. Robust trading performance in a challenging market. I don't know about robust trading performance because there was a slight downgrade in the profitability, but we'll go with it. So delivering organic revenue growth of 3.4%, which isn't too bad, I would say. They said that we chose not to participate in what was more of a promotional environment. So when we look at the gross margins, that's very clear. Obviously, maybe if they did participate in that, they could actually say, oh, look, our revenue growth is absolutely amazing, but then it would hurt the gross margins, it would hurt the profitability, the profit might come in lower. Just because you sell more doesn't mean you end up with more profitability. So that's a key thing to kind of point out there. That probably shows that they can still do a bit of pricing power here, which is good to see. So they said that profit forecast is slightly below our previous guidance, as you can see. So we kind of got the hint there that there was a profit downgrade coming in. Like-for-like revenue was 1.5%. So a lot of the like-for-like people always point out, maybe go, oh, look at that, it's like-for-like's down. I've said before in the B&M videos that like-for-like it's important, but it's not make or break for me when I'm looking at an investment. You know, a lot of like-for-like growths are driven by higher pricing increases most of the time. So yeah, we delivered a strong Christmas with December like-for-like revenue 1.5%. So like-for-like was actually improving in December, which is key to point out, which says to me that obviously we've got October numbers were weak. It sounds like to me November was a weak period as well, but then they rebounded during the Christmas period. So October, November weak, which lines up with what they were saying about the uncertainty caused by, you know, the NI increases and obviously US election, because let's not forget that this is, you know, a majority of a US company now. They also said that Hibbett traded slightly ahead, which is good to see a new acquisition still performing quite well. Year to date, like-for-like revenue is flat, so we've seen a bit of a deceleration in January, but if they can keep like-for-like flat, I think that would actually be okay. But they said organic revenue for this period was up 3.4%, and we expect organic revenue to be 5%. 5% is okay in my opinion. Obviously, key thing is to keep opening up those new stores, and that will drive the growth for now. Gross margins remain bust, so like we said, they're not decreasing the prices to get sales, which is good. Gross margins stayed around where they were previously. So this is the big thing that probably the stock is moving off, is taking into account we now expect the full year profit before tax and adjusted items to be between 915 to 935 million on the guidance. So yeah, they said that on the last update in October that it was going to be to the lower end of the guidance. A few people said this is a profit warning. I don't count it as a profit warning because it was in the guidance that they said. It's just the low end of the guidance. This here is, I guess, a slight bit of a profit warning because they have had to lower it down. Now the key thing is when you look at how much they have lowered it down. If we go and have a look, so previously they said they're going to come in the low end of the guidance, which was 955 million. So they've lowered it down now to 925 million. So if we have a look there, that's around about a 3% decrease on the guidance here, which relatively, when you look at that, it's not really a major decline on the profit guidance. Obviously, a few reasons why is the likes of the FX impact and a few extra costs that they didn't see happening. So yeah, maybe they could have done a little bit better managing this, and maybe the market's punishing them going, oh, now you've said the lower end of the guidance and now you're going even lower. You need to get control of these numbers. It's a relatively new CEO, so maybe the market's, that's wrong company. Maybe the market is kind of saying, look, you came in September 2022, we're still trying to see if we can trust you. You come in along the low side of the guidance, and now you're lowering it. You need to prove to us that you can actually hit the numbers. Yeah, maybe that's why the market has thrown it down so much. I still think it's too much. You know, the fact that this was a £1.50 stock, and since then it's only downgraded its profit guidance by 3%, but yet the share price has fallen 42% since that time frame. I just think there's just way too much fear in here for me. I don't think the stock should have had this much fear here for what they've kind of done here. And if we do look at the numbers still move up in the right direction, as you can see here from a revenue growth point of view. Profit maybe a little bit more choppy, as you can see here, but we look here, 539 million last year. Obviously, we've got the profit downgrade that's going to come in, but we're still expecting good growth. And historically, this company has been a company that has, done very good growth. Next year, analysts are expecting 723 million profit. We'll see. Obviously, there's no guide in this quarter, but if they get anywhere near that, that's going to be absolutely ridiculously cheap. And let's not forget, it's pretty good profit margins for a high street retailer. Financial health wise, it's a pretty good balance sheet, as you can see here. Yeah, a little bit of debt increase because of the acquisition of Hibbett, but they throw off good profitability where they'll be able to pay that off in a few years' time, and they've still got more cash to debt, which is absolutely fine, as long as it stays under there. Ownership wise, I don't think there'll be too much buying going on because they already bought some shares about 12 months ago, and they bought these shares as well at like £1 range, so it's even higher than where they are at right now. We'll see if it happens, but I don't think there'll be any. I mean, overall, you look at the company now, and forward P, it's down at a 6 times earnings. If we look at what we expect the numbers to close at, probably around about now, we're probably, obviously with a little profit change today, let's just call it 8 times forward earnings. Probably should have worked out a little bit more precise for you guys, but let's just call it 8 times earnings overall. I still think it's cheap for a company of this quality. That balance sheet you get, the profit margins, the growth, historic performance, well, I think there's just too much fear baked in here for me. Look at Foot Locker, a US company that's very similar to what JD Sports is, a company trading at around about 11 times forward earnings, and JD financials have been a lot better than, the likes of Foot Locker. Look at Nike, for example, their financials have been a lot better than Nike. It's just way too low for me. And even when you look at JD Sports, JD Sports, in my opinion, should be a company trading at you look at other kind of retailers in this kind of space, or other high street retailers that are good brands. A lot of these high street retailers are trading 12 times earnings. I would argue the case that JD Sports could be even a bit more of a premium, because it's, in my opinion, it's a high quality high street retailer. I would argue the case that potentially, you're looking at 13, 14 times earnings. It's just way too low, in my opinion. Now, I was looking at some other opinions out there. So I went to Stockopedia, see what's going on there, and my good friend Megan put out a bit of a piece on it, and it was nearly as bad as the last one that I read from her, but I can't even remember which stock it is. So she went amber red on this. Now, if it was amber, I could let it go because it was a profit warning. When I saw the word red, I won't say what I shouted at the screen, but it wasn't good. I can't understand how you'd be red on this report. So it's opened up with another profit warning. I disagree. They said last time that the lower end of the guidance. Now they have downgraded the profit warning. Let's not forget though, this isn't a big profit warning. Like we said, it's moved down by 3%. It's not that much at all. I'm not sure I agree with that. I looked at the bottom of this report about the amber and red, and I also saw that I also don't like the balance sheet, which is heavy on debt. I don't understand this either, because let's just go back to the balance sheet. The balance sheet is actually pretty good. So there was a slight increase because of the acquisition of Hibbett, okay? But let's not forget, the cash balance is still higher than the debt. The debt to equity ratio is still 31%. Let's not forget this company is it previously had a bit of one-off expenses. That's why there was a dip in profitability, and that's why the profit is bouncing back a little bit now, because of these one-off payments that they had with, like a couple of acquisitions, for example. But, right now, whatever profit they kind of throw off here, whether it be about 400 million of profit next year, there's a big increase expected. Obviously, there could be a change in that one. But whatever it is, it's going to be quite a few million of profit. This company has higher profit margins for a higher street retailer. The profit they're going to do, this debt is going to be minimal compared to the profit that this company is going to be throwing off in a few years' time. So I don't understand how you can say this is a bad balance sheet. In fact, I would go as far as saying this is a very good balance sheet for a high street retailer. So I just totally don't agree with that one. Once again, I think I said the same thing when she did another report that I didn't agree with, which I can't remember which report that was. Was it B&M? I can't even remember. But what I'd say is that I feel like Stockopedia do the same thing as the market sometimes, is that a little bit of negativity, the share price goes down, fear, worst stock ever. And I look at JD Sports and I go, what else do you want? What else do you want a company? What else do you want from a company? This has been a tough time for retailer. We only have to look at the competitors and seeing how much they've struggled. But yet these guys are still doing good amounts of profit. They're still holding on to the gross margins. They're still growing revenue. Imagine when time frame gets a little bit better from JD. The numbers are going to be absolutely exceptional, and yet you're getting 8 times earnings. Now, how much do you have to look at a 40% drop on a stock where there's only a 3% change in the guidance to go, actually, you know what? Yeah, the results aren't amazing, but when you look at the valuation, you got to look at this and think, actually, these numbers are pretty damn good for a company that is lost 42% of its value. I just totally don't agree with that. And then I obviously went to have a look at Paul Scott's opinion, and it made me laugh because obviously, the guy that used to be there at Stockopedia and obviously gone to do his own platform now, which, by the way, he puts absolutely amazing content out if you do want to go and subscribe to his Substack. I do personally, and he actually went green on JD Sports, which kind of shows you a big difference there. And I would personally agree with Paul Scott's opinion, which was very much like me. What else do you when you look at an opportunity here, how much lower do you want it for it to be a good opportunity? And the last point I want to make about JD Sports is, when we look at the breakdown of the company now, it's basically an American business now. The biggest part of their business is America, 35%. And as you can see here, the change is growing more and more. We went from 32% up to 35%. So the America segment is going bigger and bigger. This is now becoming an American business. As we know, American businesses normally trade at a bit of a premium. But for JD Sports, it's just not happening. You look at Foot Locker. Foot Locker is, very similar to the likes of JD Sports. But you look at their recent quarter and their total sales was down 1.4%. You look at the loss. They're now a loss-making business. But you look at Foot Locker, and Foot Locker's 11 times forward earnings. You know, like we just saw, JD Sports is down at 6. So how is it that Foot Locker is not as good a company as JD Sports? They're doing worse numbers than JD Sports, and yet it's double the share price. And that kind of got me thinking, because I was looking at that and thinking, how long does someone stare at JD Sports and look at how good it's been, and they see that big stink in the share price right now, and they're thinking, okay, I can get a better, company than Foot Locker here at 6 times forward earnings, growing a lot better balance sheet, before they start looking at that company and thinking, you know what? Some of these investment firms, private equities, must be staring over JD Sports and going, we can buy this at 6 times forward earnings. Let's stick a 100% premium bid on JD Sports. Let's say we put 180p on JD Sports. They put an offer on at 180p at JD Sports. They think, okay, we're getting something similar like Foot Locker, but better. It's coming in an American business. We own this business for 5 years, keep increasing that American business, the financials do very well, and then we spin it off onto the US markets in 5 years' time, and we make a load of money on it. How long now that JD Sports keeps going here until, and this is not a point to take serious, by the way, this is just me kind of throwing a few things out here, but how long some of these companies in America are going to stare at that and go, you know what, let's throw a bit of an offer on JD Sports, and then JD Sports from there can say, you know what, we'll take 180p. I don't know if they will. Obviously that's still a bit lower than where it was in 2021, but where they were in 2023, I don't know. Maybe they are tempted to take it. We'll see. But also, even if it isn't accepted for JD Sports, they'll be able to put a media post out about it, going, hey, we had an offer, but we turned it down for 180p. Imagine where the stock price will go in the next couple of days when that comes out. Now, like I said, that's not me saying that that's going to happen, and I'm not investing in for those reasons, but you got to start thinking that at these sort of levels, someone from a US firm is going to be looking at what the pound to the dollar is at the moment, and looking at what it cost. It's nearly a US business now. When you look at what it trades at multiple to like Foot Locker, I don't know. I think that's also something that's got to be hanging over JD Sports' head. Not that, like I said, I'm not saying it's happened, but you've got to think of all cases scenario here, because I just think this is way too low. So yeah, overall, I think that I think it was a golden opportunity. I don't think we should have seen a stock drop 10% over a 3% downgrade in the profit. I mean, overall, since the point where the stock was a £1.55 stock, the stock has fallen 42% since that time frame, and the only thing that's changed is profit is downgraded 3%. For me, it's just a bit too low at the moment. So I think the update wasn't great today, but at the same time, you've got to remember how low it's valued, and you look at all the other competitors in the space, they've been doing even worse numbers than JD Sports. So you imagine when there's a slight uptick in this space, the numbers that JD Sports will do, I think it's a good opportunity, especially when you look at the value, like I said. So hope you enjoyed the video, guys. Hit the like button if you're not here, subscribe. See you in a bit.